From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
It's 30 minutes into the U.S. trading day, Friday, March 4th. Here are the top market stories we're following for you at this hour. Stakes, they're getting higher. 9 days into the war, Ukraine says Russian forces attacked a nuclear power plant responsible for 20% of Ukraine's electricity and Europe's largest atomic generator. The NATO foreign ministers condemn the attack. And markets, they're not letting up. Investors taking their cue from the geopolitical risk, with stocks under pressure and bonds catching a bid, even in the face of a hawkish Fed, while the rush to commodities heightens. And some good news, finally, a payroll surprise in the headlines as the American recovery story continues. Non-farm payrolls increasing by 678,000 last month as hiring booms across America. From New York, I'm Kriti Gupta with Guy Johnson in London. Alix Steel is off. Welcome to Bloomberg Markets. Guy, a lot of bad headlines and really risk-off headlines, I should say, but there is some good news nestled in there, and that, of course, is that payroll surprise.
Yeah, these markets make sense, but they don't make sense, Kriti. And it's amazing. You just got to look at it and figure out which way you want to look at these markets. You've got an amazing payroll number, 678, as you say, the figure. Really strong details below the line. Then you look at what is happening with the US 2-year, down by 6, nearly 7 basis points today. You look at what is happening in Europe. All seems slightly counterintuitive. Then you, of course, roll in what is happening in Ukraine, and it all makes sense. But you do have to wonder, with CPI coming out next week, expected to be circa 8%, with the Fed sounding very, very hawkish, whether or not actually what we're seeing in the bond market right now is a misrepresentation of the reality of the trajectory that central banks, at least in the United States and elsewhere, are on, maybe less so here in Europe. So that kind of comes to our question of the day. Will the war effectively derail the recovery? And is that what's being priced in to these markets right now? Joining us now to discuss it, Heidi Shierholz, Economic Policy Institute President and former Labour Department Chief Economist, and Bloomberg's Mike McKee. Mike, let me start with you. The data that we got today, just kind of give us some perspective on it. The headline number looked very strong. I appreciate the wages didn't go up very much, but nevertheless still remain elevated. This looks like a very strong number and a representation that the U.S. economy continues to power on and on.
Yeah, I think you take the actual level number and you don't have to really pay a lot of attention to that. The idea that it is strong is what matters, because the Fed's theory has been, and we've heard this from Jay Powell, that Omicron was a big problem in January, and that kept people from going back to work. And now, as the disease fades, more people would come out and look for employment. And that's apparently what happened. We saw a big rise, over 300,000 in the labor force, and we saw 678,000 jobs restored. So at this point, it looks like the Fed has the narrative that they've been looking for. And Jay Powell's already said that qualifies for a 25 basis point increase. What's going to happen after the CPI report next week is everybody's going to start asking Powell in his news conference after the Fed decision, what about 50 in May?
Michael, let's talk a little bit about, very quickly, what actually isn't in the jobs report. And that seems to be some more improvement, essentially, in when it comes to, say, government, state jobs. You're seeing improvement in a wide variety of sectors, but not particularly when it comes to government jobs. Your thoughts?
You know, it's probably a bit of a statistical anomaly in being caught up a little bit in the seasonal adjustment factors that they use, because a lot of people who are employed by state and local governments in education, not teachers, but contract employees, are off for much of December. And so we saw some big adjustments to the January numbers as well. And so that may be the reason. I don't think that there's a big pullback from states, although they're not getting as much money from Washington as they were.
Heidi, let's get your take on this data. What does it tell you about where we are in terms of the economic recovery? Are we now post-COVID? What does it mean for the Fed?
This was an extraordinarily strong report. I slacked my colleagues immediately when I saw the numbers. I was going, this is just an astonishingly strong recovery We have now regained more than 9 out of every 10 jobs that were lost. This is it's just there's still a gap to fill in, depending on how you measure the counterfactual. The total gap in the labor market right now is somewhere between 4.5 and 6.5 million jobs, so we're not done yet, but the gap is closing astonishingly fast. I just wanted to make one comment about the state and local government jobs. That actually is one area where we are not seeing the strong improvement that we're seeing elsewhere. We have, state and local government jobs, like in the private sector, saw a big decline when COVID hit, but have not seen the same kind of recovery that we've seen in the private sector. It's a little bit odd, like state and local government jobs got a lot of recovery dollars in the American Relief and Recovery Plan that was passed 1 year ago. They should be spending that money to hire back those state and local government jobs that were lost. In particular, we are down hundreds of thousands of jobs in K through 12 public sector jobs, K through 12 public education. It's just, these kinds of losses are incredibly damaging, not just right now, but sort of to our long run productivity when we're thinking about not having the kinds of resources that are going to our kids. So it's really important that state governments do what they can to hire back the jobs that were lost. And we're not seeing that yet. I really hope it is growing, but at a very slow pace. I hope we do see the increase of those jobs going forward.
Heidi, we just heard about from the Fed, but Mike, let's bring you in here because this is going to be a really important conversation, right? We heard Heidi talk about the Fed, this really blowout payrolls report. Well, let's bring it back to the question of the day, right? Will war derail the recovery? It seems like for now, it's taken 50 basis points off the table in March, but is that going to be a longer term issue for the Fed when you perhaps see the pricing?
Well, I would say two things. One is that we don't know longer term because we don't know what's going to happen.
Right.
Suppose we did have a nuclear reactor go down over there, that would frighten Americans and might cause people to pull back on spending. So that's an unknown. But if we continue on the same path that we're on, I don't think it derails the U.S. recovery at all. It's a different kind of recovery because we're not coming back from some problem with the economy. We're coming back from a pandemic where we just shut down the economy and are trying to reopen it again. So it isn't going to follow the same trajectory we've seen in the past, and it could come back a lot faster as it's doing. Europe, though, is a totally different subject, and the worse it gets, the worse their recovery looks, and they could seriously face problems going forward.
Stagflation definitely on the table here. We're going to talk about that next week with the ECB. Heidi, sticking with the United States, though, for now, the wage price spiral fears. We didn't see wages going up significantly today. Can we park that for now, or do you think today's data doesn't really resolve the debate?
It definitely gives us a lot of information about the debate. Wage growth is decelerating. And this question of the wage price spiral is super interesting. When you dig into the data, you don't see a relationship by industry between wage growth and price growth. Like if you do a scatter plot where the individual observations are industries looking at comparing wage growth to price growth, there is no correlation. So we are not seeing that feedback between wages and prices to any really even visually available sense. So one thing that we know is when you step back and you think about what's going on, we know restaurant wages are growing strongly, but we don't see restaurant prices increasing. We know used car prices have gone up a lot, but those by definition were made by workers years ago. So that's not about wage growth. We just are not seeing this wage price spiral. And that makes it easier for what we know the impact of this inflation will be going forward. In other words, that's good news for the U.S. economy.
Well, good news for the U.S. economy, Heidi, but let's broaden this out. How much of the conversation is simply about the uneven recovery? We were talking about this even before the war broke out between Russia and Ukraine. It seems like that issue in particular, the idea that China, Europe, and the United States are all really on different paths when it comes to monetary policy. How much of that is a problem?
Yeah, I do think that just focusing on the U.S., I do think that the war in Ukraine is going to have some impact. It will increase our gas prices for sure. It will have an impact on inflation. Not much the Fed can do about the increased gas prices as a result of what's going on in Ukraine. We may see some impact with people pulling back because of an effect on consumer confidence. But I really don't expect to have it have a huge impact here. I don't at all expect it to derail the economy. May slow things down a little bit. This economy this recovery is incredibly fast and can actually weather this storm, I think pretty solidly.
Let's just pick up on that point that Heidi's made, Mike. This is an incredibly strong economy. It is powering ahead in the United States. The data certainly support that. We're going to get a strong inflation print next week ahead of the Fed. Does it make sense to you that yields are going lower in this environment?
It does, Guy, and I'll tell you why. It's not about the economy. It's about the uncertainty at this point. I think we're seeing a lot of flight to safety in the United States, and that really accelerated last night with those nuclear reports. And so that's what's driving things down. Absent Ukraine, we would see probably 10-year yields over 2%, and, looking for some sort of ceiling. So I think you just have to look beyond that at this point. Now, obviously, it complicates the Fed's job in terms of slowing the economy because financial conditions don't tighten as much as they anticipated. But it's not much they can do about it at this point.
Well, Mike McKee, Bloomberg International Economics and Policy Correspondent, and Heidi Shierholz, Economic Policy Institute President, we thank you so much for your time. This is Bloomberg. It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. Let's bring in Ritika Gupta.
Thanks, Kriti. JP Morgan is warning that Russia's economy could be headed for a major collapse. The bank's analysts say with increasing disruptions to the country's exports, Russia could see a situation comparable to the fallout from the country's default back in 1998. JP Morgan is predicting a peak-to-trough crash in Russian GDP of about 11%. Bond traders are delivering a swift, punishing verdict on the expected hit to Russian corporations from the Ukraine war. It is basically turning the country into a nation of junk bonds. More than three-quarters of bonds issued by still investment-grade non-financial corporations in Russia are now trading at distress levels or carry risk in line with junk-rated debt. That's according to Bloomberg's market-based default risk model. And Microsoft is the latest company to limit business in Russia. The U.S. tech giant says it is halting all new sales of products and services in Russia as it condemned the country's invasion of Ukraine. Microsoft says it will also help cybersecurity officials in Ukraine defend against Russian attacks. And that is your latest business flash. Guy?
Ritika, thank you very much indeed. We need to talk about what is happening in these markets right now. You've had an incredibly strong payroll number today. Equity markets, though, are coming under pressure. Bond yields are catching a bid. Commodities obviously continue to surge ever higher. Europe is taking it harder than the United States. Is the US now a safe haven? I think that's the question that we need to be asking. We'll be doing that next. Grace Capital's Kate Faddis is going to be joining us. We're looking to see exactly how she is repositioning in the light of these Ukraine risks. That conversation next. This is Bloomberg.
Ukraine, a hawkish Fed, simply a decelerating growth story. Where do you position when you have essentially a wall of worry right now? But right now it seems like defense names in particular are catching quite the buzz. Let's talk about ETFs because, of course, it is ETF Friday. So I brought up this terminal here to really show you the flows that are going into the defense stocks. We know this has always been, not to put a pun on it, Guy, but essentially a defensive sector to begin with. But take a look at this. When you actually have a war on Europe's doorstep, you do see see this massive bid going into some of the most popular ETFs. It really speaks to the fact that not only is commodities the way to play this particular geopolitical risk, but defense names also getting a bit of a bid. Excuse me. Let's take a deeper dive into that. We're joined now by Kate Faddis, Grace Capital President and CIO. Grace, thank you so much for joining us. Let's start off with that topic. Let's talk about the defense sector, because we never talk about the defense sector. We talk about tech, we talk about commodities, but right now, this is a sector that's really getting its time in the spotlight.
Yeah, defense is the place to be. Look, even if this turns to be a short-term conflict, defense is going to be a net beneficiary. Germany has announced 100 billion euro defense spending. I think other countries are going to continue. So if you look at some of the defense names in the US, CACI, Lockheed Martin, Raytheon, Booz Allen, these companies are doing extremely well. In talking about defense, don't forget about cybersecurity, because along with physical defense, you have CTOs worried about cyber criminals, state-sponsored cyber terrorism. So CrowdStrike, Fortinet, Palo Alto are doing very well in this environment.
Kate, good morning. It's Guy. What about the energy sector? This is another area that people have been using to play the situation in Ukraine, to try and get some protection from what is happening as commodity prices rise. Just talk to me a little bit about, though, the risks of putting fresh money to work there. We've obviously seen a lot of money flooding in. Is there a danger that if you put money in too late, that you could actually see a huge reaction going in the other direction? Say we get the Iranian talks working out this weekend and we get progress there. More crude comes onto the market. If we do see a ceasefire in Ukraine, that would be fantastic, but it would have a meaningful impact on the energy sector. How volatile do you think that area is going to be?
I think, Guy, you have nailed it. The energy sector is cyclical. So you buy low, sell high. This is a classic buy low, sell high situation. We are more inclined to be selling energy here. Don't overthink it. It's a very simple sector. Right now, we own names like Cheniere Energy. Cheniere is at all-time highs because gas prices in Europe are up something like doubled. So Cheniere, which exports gas from the US, is trading at all-time highs. This is where you sell or cut back. You buy low and you sell high.
So you said it's already at a record, Cheniere in particular, but energy broadly has caught this kind of nonstop bid, and yet you have so many people calling for oil as high as 185. I believe JP Morgan was out with the note this morning. I'm curious, though, what happens if you do start to see some of these shale producers, some of these American energy producers add on supply to the market. Do you continue to invest in companies like that when you potentially see oil prices perhaps coming back down to earth?
You do not, because there's always a lag. So right now, there's insatiable demand for energy. So oil companies are going to be adding supply. By the time they finish adding supply, there's going to be an oversupply on the market. At that point, prices are going to go down again. This conflict isn't going to go on forever. So I think you have to be very careful. Right now, oil is at triple digits. Gas prices in Europe are up tremendously. Now is not the time. Now is the time to be circumspect about energy prices.
Okay, you bring up Europe, so let's talk about it. Europe has had a terrible, terrible week. Equities have been under really significant pressure. The banks have been hit hard. There was this narrative case at the beginning of the year that you wanted to put money to work here. Has that now been completely upended? Is the United States now the safe haven when it comes to equities, despite the relative drops that we've seen there?
Absolutely. The U.S. is the place to be. And frankly, I would avoid the financials. The financials, there was a narrative around the financials that you're going to have a rising rate environment and these banks are asset sensitive and therefore they're going to do well in a rising rate environment because deposits are going to be held and they're going to make incremental profit. I think that you're not going to see that happening. I think the Fed is going to be very cautious now about the number of hikes you're going to have. And then if you look at the European banks, I think the European banks are in trouble. You look at exposure to Russia, you look at counterparty risk, even on the asset management side, the Goldman Sachs, the JP Morgans. If we have this continued downdraft in the equities market, it's going to affect bank earnings. It's going to affect fee income. So US is a better place to be than Europe. Frankly, there's nowhere to hide. There's nowhere to hide in this market. I think this is a very tough situation. Energy, maybe that story has been played out, maybe it hasn't. Commodities. We're going to be in an inflationary environment. It's going to be very tough.
Well, let's talk about the currency impact here, if we can. You mentioned the euro, you mentioned the European banking sector, but we also talked about commodities largely priced in the dollar, and yet you're seeing the dollar climb and climb, get stronger and stronger, simply as perhaps removing that exposure from Europe, but also that classic haven bid. Talk to us a little bit about the currency impact. How much more dollar strength can we really expect, and how does that ripple across some of the other investments?
I think the dollar is going to continue to strengthen, and paradoxically, there are going to be other currencies that are going to do well. Look at something like the Canadian dollar. The Canadian dollar is a beneficiary of commodity price increases. So the Canadian dollar is doing well. Look at the Aussie dollar. The Australian dollar is also doing well because, again, these are commodity-based economies. So as you're seeing people move away from Russia, people move away from Ukraine, it's not just a matter of the commodities. It's who's going to the ports to get these commodities from these countries. And they're major commodity exporters. They're major commodity exporters with certain food, wheat, things like palladium, which are used in catalytic converters with cars. So I'm going to be looking for strength in the US dollar, and I'm going to be looking for strength in some of the other countries that are commodity led.
Okay, final quick question. In terms of what we should be expecting in terms of rates of return this year, what are you looking at? Do you want to be fully invested? How should people be thinking about their portfolios right now? Should they be being defensive? Should they be looking for opportunities? I'm just wondering from a sort of psychological point of view of how you're approaching investing and whether or not that's changed.
It's a very good question. Here's the bottom line. Short-term price movements are random. I've stated that over and over again. 90% of the move happens in 5–10% of the time. So I do believe you have to be fully invested. This situation isn't going to go on forever. If you have a well-diversified portfolio, you are going to be fine long-term.
Yep.
So I'm not overly concerned if you are in it for the long term. In the short term, we're going to have some funny behavior.
Kate, thank you very much. Kate Faddis of Grace Capital. This is Bloomberg.
We're an hour into the U.S. trading session. A risk-off mood, it seems. Bloomberg's Abigail Doolittle is tracking the moves. Abigail, a lot going on right now.
There is certainly a lot going on right now, Kriti, for sure. A real risk-off tone, to your point, as the strong jobs report here in the U.S. overshadowed by the geopolitical tensions and the Russia-Ukraine war. You can see the S&P 500 near session lows down 1.4%. You also have that Russell 2000 small cap stocks down sharply, down 1.5%, and the Nasdaq 100 down about the same amount. Now we're looking at the worst week for the S&P 500 and the Russell 2000 since late January. That's the degree of the selling pressure. And we're seeing it in the VIX, that quote-unquote fear index, now at a 33 handle. And there are continuing reasons to think that it will go higher as we just have this, what somebody was yesterday calling this move higher for volatility. Not so much a spike, but more of a slow move up, a slow grind. Now, where we're seeing a big spike higher, that, of course, is the commodity complex, as you all were just talking about. If we put it into perspective on the week, this is stunning. New York crude WTI up 24%. You have wheat up 41% on the week. Simply an incredible move there. We also have corn sharply higher, up about 19%. Of course, Ukraine considered to be the breadbasket of Europe. So these supply fears on the Russia-Ukraine war really causing this spike up here for commodities. Lumber is along for the ride, up about 11% on the idea that perhaps there is going to be the supply shortage and traders gobbling these up, at least for right now. In fact, Guy, as I'm sure you've heard many times at this point, the Bloomberg Commodity Index, when we go into the Bloomberg terminal and take a look at where we're at, the Bloomberg Commodity Index on the week is headed to its best week ever, going all the way back to 1960. Right now, we're looking at a 9.4% rise. I think it's actually higher than that at this point. I think that the rise is in the double digits. Again, the biggest rise for commodities on record going back to 1960. That's the degree of the buying power that we're seeing in the commodity space on supply fears, Guy.
Abigail, thank you very much indeed. Can I just point out that CAC 40 is now down by 4.4% in Paris. The DAX is down by 4. The selling in Europe on big volume is epic as we come into the close, the end of the week here in Europe. Crude is trading 115, Brent 115 spot 43. TI is trading 113.29. Is that a fair reflection of the risk that we see in the crude market right now? What would an Iran deal do? What's the story going forward? How big is the tail to the upside, to the right-hand side? Damien Corvelin, Goldman Sachs head of energy research, joining us now to give us his take, his short-term forecast for Brent, 115 a barrel. But what's the upside, Damien? How high could we go?
Guy, I think the key here is that the upside is actually significant. In normal times, the oil market has three buffers. We have inventories, we have supply elasticity, and demand elasticity. We have no buffer in terms of inventories left. And what shale producers have just told us once again is that the elasticity is quite small. So we're down to the last buffer, which is demand destruction. And it's one that requires big price moves, right? So if you look at the move from 100 to 115 that we've seen over 1 week, that on our mapping would be pretty much a 1 month disruption to Russian flows. But those flows are enormous, right? They're 5% of the entire oil market in terms of what goes on a boat out of Russia. So if that persists for 3 months, now we're talking $150 oil prices, right? And I think that's really the core of where we stand in the oil market today. No buffers outside of demand destruction. The potential upside as a result becomes significant.
Well, Damien, there's calls for even further than 150. I think we have 185 in some shops that they're looking at. Let's talk about what can actually make up some of the Russian supply. We see a little bit of an OPEC resistance to amp up their supply more than the $400,000 a barrel. So is the only option here coming down to shale producers? What do you think?
Yeah, let's break it down, right? So, Saudi, UAE on paper have capacity to do more. And realistically, if we look at what they've done in recent years, could perhaps add 1.5 million. It has to be a unanimous decision within OPEC Plus, of which Russia is a member, Iran is a member. So, that's not an easy decision, but conceptually that's there. Iran potentially coming back online, 500,000 initially, 1 million over a year. So that's already 2, if you want, million barrels per day. Shale doesn't respond instantaneously, right? Despite being its short cycle, it needs the cash flow to spend. You have bottlenecks on services, the same labor issues that we see everywhere else in the US. So maybe that's 1 million over another year, right? So that's 2 maybe in the next few months, 3 potentially over a year, year and a half. That can help. But again, Russia puts 5 million barrels per day on boats. So we do need to see a normalization, a recovery at least in flows. Second, if you bring that supply online, okay, you can match the lost molecules, but you have nothing left, right? That's the core point. The oil market is inherently volatile. Yesterday we lost some Libya output. Over the weekend we lost some Iraq output. If you're bringing all those barrels, there is nothing left, right? So it is still bullish, even if you can find the supply to meet consumption needs.
It sounds like you're saying that there's really very little buffer in terms of where else you can get the supply, if not for the Middle East, even if you do get those barrels at a lag. Talk to us a little bit about when they would perhaps have to pull out the more extreme option, which of course is the Saudi spare capacity in particular. My understanding is that if that is a level that's ever breached, you start to see the oil market panic even further. But is this a situation that might justify that?
Potentially, again, it goes back to, the enormity of the flows that come out of Russia. So, if those are persistently disrupted to some extent, then it creates a significant call on that spare capacity. And, we know, like we look at April 2020, we know Saudi Arabia, UAE, those core OPEC producers can flex production. But as you said, the flip side of that is then there is really nothing left.
Damien, Dutch gas, UK gas, doubling this week. How sustainable are these current prices? When do we get significant demand destruction? What is the economic impact of that kind of move?
Yeah, so the move so far is enormous, as you point out. If you look at just the last 6 months, where we already had extremely high European gas prices, they're effectively now pricing a nearly complete halt in Russian gas flows, right? You just take your demand elasticity, you extrapolate to current prices, and it's saying the market is significantly worried about that outcome. Now, that's mostly a problem for industry, right? Governments, of course, would go ahead and cap prices for consumers at the retail level. But that's what the market is pricing, given, again, this significant uncertainty. Now, to be clear, right, the sanctions put in place exempt energy, right? So energy flows, our base case is that eventually would come back and normalize. The problem is with the conflict unresolved, the fear is of potential additional sanctions. And that's really what the market is seeing today, is a halt of flow or concern that flows would completely stop, because there is no clear path going forward to how sanctions may not eventually include energy. That's really the fear today in moving molecules outside of the region.
Damien, you've talked about the idea of demand destruction. Let's talk about how that affects people in the United States in particular, especially coming up to the summer where we do have that driving season. What are you watching for when it comes to the American gasoline market?
Yeah, so I mean, it goes back to the price elasticity of consumers. If we look back, 2008 would be the case study where gasoline increases sufficiently that on the margins consumers start to reduce their consumption. Now, the world has changed in 2008. On aggregate, U.S. consumers are wealthier, their cars are more efficient. So that suggests that point of demand destruction is not here. It's definitely at a higher price. Now, again, not our base case. We would expect flows to normalize. But if you had to resort to that, then you see why the oil price level required is definitely above $115 where we are now.
Damien, great to get an update. Fascinating insight into what is happening here. Always appreciate your time. Damien Corvillan, Goldman Sachs Head of Energy Research. Thank you very much indeed. I just want to show you what is happening in European equity markets as we come towards the end of the day. We're around an hour away from the close. Credit, we are down and down hard. The CAC 40 has been down north of 4%. We are watching very carefully to see what's happening in Italy. It's down circa 5%. These are huge drawdowns that we're seeing here in Europe. We'll have more on what is happening coming up next. We'll be discussing Moscow's tactics in Ukraine, clearly drawing international condemnation. We will talk about that next with Andrew Lowson, Centre for Strategic and International Studies. He's a fellow there. He's up next. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta. You're looking at a live shot of the principal room. Tune in to Bloomberg's monthly series, Chief Future Officer. This episode featuring Macy's CFO, Adrian Mitchell, is out now on Bloomberg.com and YouTube. This is Bloomberg.
Overnight, Ukraine says Russia attacked a nuclear plant that accounts for 20% of Ukraine's electricity. Bloomberg's Maria Tadeo is in Brussels outside the EU Council. Maria, give us the latest. What are you hearing?
Well, not outside. Luckily, we're inside. But of course, this is where a meeting is taking place. And we've heard now from every major official that's attended this meeting of Europeans and also the U.S. Secretary of State, Tony Blinken, here. And of course, the big question is, what do we do after the pictures that we saw last night of a fire breaking out near a nuclear plant in Ukraine? What we know right now, of course, is that the reactors were not affected. There has been no radioactive leakage on this. 2 people were injured. But the big question is, what is Russia going to do with this site and who is controlling the premises? Now, for a lot of officials here, this is a major sign of escalation. They believe that in many ways, for 3 days now, Russia has been trying to actively pursue this path of nuclear tactics, to say we're going to put our nuclear deterrence on a high alert. We heard it from Vladimir Putin yesterday. We heard it from Sergei Lavrov. And today we have this fire breaking out at a nuclear plant. For many, they argue this is now a clear sign of escalation for the Russians, and we need further sanctions. So right now there is a very active discussion as to whether the European Union should cut fully oil and gas from Russia. Remember, Gazprom still continues to supply to the European Union, and Sberbank, the Russian bank, continues to process some of those deals. I have heard from a number of Eastern European countries, particularly concerned, by the way, about the situation in Belarus, saying this is a time to fully ban everything. You know, whether or not that happens, it remains to be seen. But of course, for the Ukrainians, this is also equally concerning. And NATO today repeating and insisting that they won't put boots on the ground. They're not going to go for a no-fly area either on the country. They believe this could lead to an even bigger escalation.
Well, let's talk a little bit about that. As you go out towards NATO headquarters, out towards the airport, Maria, there is a definite sense of nervousness at the moment. The Secretary-General earlier on making it clear there would be no-fly zone. The risk of escalation just too great. Given that, what can NATO, what can Europe do?
Look, I think what they feel, and the reason, by the way, why this was so concerning for them, and we know there was an active discussion today as to whether or not this no-fly area should be installed, and we know that the Ukrainian government has been essentially begging for days to say we need to have the skies clear, because right now the big advantage that Russia has over Ukraine is on the skies. They're battling from the air to the ground pretty much every day, hammering the country. Now, for NATO, the concern was, of course, if you have a no-fly area, you need someone to enforce it, and that means NATO planes patrolling the skies. Now, you see, and you can see the potential for an accident to happen with a Russian flight or a Russian plane, and at that point, this would take a much bigger dimension. Now, what I've heard from a number of European officials, again, some in Eastern Europe particularly concerned, is that we need to see more NATO troops in those countries that do belong to NATO. And then secondly, if you're not going to close the skies for Ukraine, then you need major weapons. They have to be able to stay competitive on the air, and they need to have systems on the ground to be able to repel the bombings that we're seeing from Russia. And by the way, Guy, yesterday, Vladimir Putin was on Russian TV saying Russia has a strategic mission to meet and comply with in Ukraine, and they're going to fulfill those objectives. He said, quote, this mission, remember, Russia's banned to use the word war in Ukraine. This mission is going according to plan and will continue.
Fantastic work, Maria, as ever. Thank you very much indeed. Bloomberg's Maria Tadeo joining us from the European Council building. Thank you very much indeed. Let's bring into the conversation Andrew Lowson, Centre for Strategic and International Studies in Europe. He's a fellow there and the Eurasia programme. Andrew, Maria talking about Vladimir Putin's objectives in Ukraine. I have yet to hear anybody articulating those objectives clearly. What do you think they are?
Well, we heard from President Putin himself on the 24th of February that what he was trying to do was denazify and demilitarize Ukraine. The Nazi trope has been one that Russia has used to malign Ukraine for a long time. It's absolutely baseless, and it's just a code word for regime change. So he wants to remove Zelensky, replace him with a more pliant leader, and he wants to get the Ukrainian military to stand down their arms and accept a enforced neutrality. They simply don't want to have a country that might eventually move toward NATO on their borders.
Andrew, can you talk to us a little bit about the ramifications of these actions within Russia itself? Talk to us a little bit about the picture of stability in terms of domestic politics. What does it look like?
Well, for years, Putin has assembled this so-called vertical of power, whereby he has absolute authority over pretty much any consequential decision that might affect Russia's domestic or foreign affairs. The challenge here is that he's launched a war that is essentially unwinnable. His objectives are unachievable. And the Western response is a lot more united and difficult than I think he would have expected. At this point, the economy is melting down. Russian forces are facing some setbacks on the battlefield, even though they are still pushing forward. So I think that's going to raise pressure on him, both from the streets and also among his advisors, among the top political elites. That's going to put him in a position where he's been more vulnerable than ever before, although he certainly still has plenty of tools at his disposal to keep the lid on discontent and dissatisfaction in Russia.
Many military strategists, tacticians, will talk about the fact that you don't want to push an enemy into a corner with no way out. Are we pushing, with the ferocity of the response to this Ukrainian invasion, Vladimir Putin into a position where he has no way out other than to escalate?
That is certainly a risk. What we've seen here is that Putin apparently really perceives his country to be at risk. I think the fact that he's brought up this potential, raising the readiness of nuclear forces does up the ante a little bit. And I think that just shows, how he perceives the Western response to Russia's aggression as a strategic threat. So right now, we understand that the nuclear forces have gone from the lowest to second lowest level of readiness. And this is something that I think is reflective of Russia's long-held military doctrine of escalating to de-escalate. You raise the potential for the use of nuclear weapons on the assumption that your adversary will perceive that that's too much of a risk and they'll back down. I think that's what we're seeing here. Putin is really running out of options in terms of trying to control the narrative, to keep the lid on things, and to counteract some very difficult sanctions and punitive measures that the West have brought against him.
Andrew, we just talked about escalation. Let's talk about de-escalation. One of the major issues in terms of this conflict when it comes to simply the read-through into international markets is, of course, the oil supply. A lot of the assumption here is that Russian barrels are going to be completely taken off the market. But if you talk to oil strategists, and we just did this earlier in our show, we do actually really need those barrels. So is there any situation or any near-term situation or scenario, I should say, that actually means that those Russian barrels can actually get back on the market, perhaps in a scenario of de-escalation and just getting on better terms between both countries?
Well, I think now that the effect of sanctions is being felt, there might be some pressure on the Russians to actually come and find some sort of pathways for de-escalation, to have some sort of negotiations open up. I haven't seen or heard too many conversations in Washington lately about giving Putin that de-escalation pathway. I think we're still so early in the application of these sanctions that they're still kind of taking their effect. We want Putin to feel that pain politically and economically. In order to protect the flow of oil and gas from Russia, I mean, there has been an effort to ensure that sanctions aren't targeting those sectors. Again, however, as this situation escalates, that might have to come on the table. But if Putin really needs to keep those flows going for his own regime stability, then he might be compelled to consider changing certain tactics, maybe refraining from the use of certain weapons, some sort of limitation to be met in response by a reduction in pressure from the West.
Fascinating stuff. Of course, we'll bring you those live headlines when we get them on Bloomberg Television and Radio. Andrew Lowson, thank you so much for your time. He joins us from the Center for Strategic and International Studies. He, of course, is a fellow there. Thank you for your time. This is Bloomberg.
So we are wrapping up the session. We're wrapping up the week here in Europe. And wow, what a week it has been. European assets have been smashed lower. Well, at least equities have. Commodities have been rising. Bond yields obviously pushing lower. Bond prices going sharply to the upside. It is a very strong risk-off narrative here in Europe. So today, let's just deal with today. We'll talk about the week that has been in just a moment on the other side of the break. But the Stock 600 today is down by 3%. The CAC 40 is down by over 4% today. You've got the Italian market down by over 5% today. Equities with any kind of exposure to the Russia story, the Ukrainian story, being pushed sharply to the downside. The other factor that is worth bearing in mind, and you want to think about this board and this board in tandem. Euro dollar now with a 109 handle. The ECB meeting comes up next week. Every time the euro ticks lower, this becomes more expensive. Obviously, most commodities continue to be priced in dollars. As the euro gets weaker, the inflationary narrative in Europe gets more tricky for the ECB to handle. Dutch natural gas today trading up by 21%. On the week, it's doubled. We're up by 100% plus. It has been an amazing week in terms of the shifting that we have seen. We're going to discuss all of this next. We're going to be joined by Bilal Hafiz, Macro High founder and CEO. He's going to be coming up very shortly. We'll talk to him about how much of this is sustainable. What a big pivot we are seeing here in Europe. Where do European assets go next? Bilal Hafiz is coming up next. The countdown to the close is about to begin. This is Bloomberg.